Pensions damaging your pension. Let's have a look at L&G PMC, North America Equity Index Fund. Now, in and of itself, you'd think, hey, not bad, North America, what could go wrong? You really want to judge these against 2022. This was down over 10%. Again, you might say, well, that's fine, the markets occasionally go down. Yes, they do, down 10%. Okay. One of the major problems they have, and by the way, it rarely beats its benchmark by more than just over 1%. And you might say, well, that's more than enough. Well, actually, over 5 years, annualized relative, 0.2%. So why don't you just have the benchmark, save the fees, and save yourself a lot of hassle as well? They can't hold cash in those falling periods. That's the major problem. And so you're down 11%. You've got to keep watching it drop because they have to be holding equities. I'm going to put it another way. What does it currently hold? Stocks that I don't necessarily have a problem with, like Microsoft, Apple, Nvidia, Amazon, Alphabet, Meta. You could buy these yourselves. The problem here with these holdings is the amounts under 2% in most cases. Now, if they're clever and they like what they have owned, why don't they have more of it? And you might say, oh, they don't want to have too much risk. 5%? 4%? I mean, they don't have too much risk. How come they got 6% of Microsoft? Are you saying that a 2% in Alphabet is equivalent to 6% in Microsoft? No. They're underinvesting in some of the highest performers. That's the reason for them just hugging a benchmark and not delivering the kind of performance you'd want them to do when the markets are falling, which should be around, say, 0% or minus 1%, because they're holding cash and getting 5% on their cash holdings, at least positive, but they can't hold cash. So double whammy with these funds, and that's the way to judge those. More to come.